their openness to extending the ceasefire. And a senior Arab official with direct knowledge of negotiations confirms to NBC News that there will be a truce extension. Details are still being finalized, and there's still a chance the deal could collapse. And Pope Francis postponed a series of meetings today because of a lung inflammation and breathing difficulties. According to the Vatican, the nearly 87-year-old pontiff had a CT scan that ruled out pneumonia. On Sunday, one of the Pope's aides read his normal Sunday message because of issues with his lungs. Guys, back to you.
Okay, thanks, Savannah. Let's talk about the markets a bit. Of course, we are about an hour into trading. You can see where we stand right now. Nasdaq eking out the slightest of gains. Bob Pisani joins us now on set with a bit more.
I just got back. It's a tradition. My wife and I abandoned my family for Thanksgiving, and we go to a Caribbean island. We were in Antigua.
Nice.
Wonderful island, wonderful
glad.
beaches, wonderful people. I have never seen a greater disparity between what people are doing, which is spending ridiculous amounts of money. The place was packed with Brits, Canadians, and Americans, and what they're actually saying, which is worried about spending lots of money. There was a heavy degree of pessimism, and I couldn't understand why. I got into disputes with some fund managers saying, you do understand the market's really doing well, and the economy in the U.S. is holding up very well. They seem not to want to believe it. Let's just look at the markets right now before I go off on this rant about what the delusions that some people are working under. Look at the S&P. I kept saying, you know, interest rates are going down. The REITs have been doing well recently. REITs are up about 10% this month. Tech is 1% from a 52-week high. ARK's up 30%. There's speculative tech. ARK's up 30% this month. The only thing down in the S&P is energy, and with good reason. Oil has been down, natural gas has been down. So that's good for consumers, so nobody complained. But nobody wanted to believe me. I got into these arguments with people saying, at one point I just got exasperated, David. I said, you know, yes, the S&P is up 19% this year. Do you folks sitting around with your pina coladas and rum punches?
So were you berating people on the beach, walking around, Bob, and
no,
just telling them
standing at the beach bars,
to be happy?
having discussions with these people, and they don't want to believe me. I said it's up 19%. You know, the S&P is up 8.5% this month. You know, it's the best gain since July of 2022.
But where would it be without the 7 stocks, the magnificent
This is why indexing has won out. If you're not worried about it, if you own the S&P 500, this is why there's $12 trillion indexed to the S&P 500, because people don't want to think about that. Fourth best month of the last 12 years. The S&P, I got to argue with a guy who said, well, that's not going to happen. The S&P can't advance 20% a year. That's unsustainable. I said, yes, it can. It does. I've been putting this chart up, this full screen up, for years and years and years. The S&P 500 advances 20% or more 36% of the time. We're up 19%. We're about to push into 20%. 36% of the time, the S&P is up 20% or more. 10 to 20% of the time, it's up 21%. Do these first two, add it up. 57% of the time, the S&P 500 is up 10% or more a year. And look at the down times. Only 27% is it down on a year. So 3 out of 4 years, the S&P 500 is up every year. This is why investing in the stock market is a fantastic long-term bet as long as you stay in broad indexes. But nobody wanted to believe me. Everyone seemed to believe that somehow there was going to be some downturn next year, and this imminent recession that everyone keeps waiting for is somehow going to happen here. And then I got into another argument with a guy.
Oh,
I
God.
said, the seasonal
You're
trends.
not making any friends in
The
Antigua.
seasonal trends are working, and they hated that. People hate talking about seasonal trends. Don't tell me about that.
Especially while they're trying
That's
to relax
never
on
gonna
vacation, and Bob Pisani's coming up to them.
Okay.
5 pina coladas in and
The
screaming at
last
them.
week of November is the strongest week of the month, and an up month. The best month of the year is November. The last week of the November is traditionally an up month. December in a pre-election year, the average gain is 2.9%. By the way, thanks to Ryan Detrick, a great guy. He puts out a lot of these stats all the time, good friend of mine. And you say these things, and they want to dismiss it. So my point is there is some kind of mental cognitive dissonance going on here, where people are spending a lot of money at a fancy resort in the Caribbean, and we're packed everywhere, and yet they seem to be thinking that somehow the future is something dire going on. And when I asked them about this dissonance, they just like shrugged. They don't want to believe it.
Watch what they do, not what they say.
Right.
Exactly.
All these people come back from Antigua. It's a great visit. Other than this guy at the bar who's just screaming at me that I'm not positive enough on the stock market.
Have another old-fashioned rum punch. That's what they all do. They just say, oh, maybe you're right. I don't know. Let's have another.
Sounds like a fun trip, Bob.
It was fabulous. I didn't make any friends. David's right.
Oh, apparently not. You always make friends everywhere you go.
Come
on.
Friends, even if
He
you don't
always
with
makes
everybody.
friends.
Weird guy standing over there. Don't talk to him about the market.
Well, it wasn't helping. You were still yelling at them, it sounds like.
Bob, a few pina coladas.
Spewing,
Send him to Antigua.
just spewing facts, folks. That's
Thank you,
all.
Bob.
Okay.
We're happy to have you back.
Thank you.
Lots of data in Fed speak this week, but our next guest says the Fed is done for now and that while the path to a soft landing has widened, expect some turbulence along the way. Joining us now is KPMG Chief Economist Diane Swonk. It's a good time to check in with you, Diane, because the consensus feels like it's coalescing around the soft landing. The Fed is done. It's going to start cutting rates in May of next year, and that's what's keeping the market in a good mood. Does all that happen?
It is what the market is in a good mood about. I actually have it at June, but, that splitting hairs. I think, Bob Tassani just sort of illustrated or certainly summarized my holidays, but I found that the dissonance out there, the cognitive dissonance that we see between the economic aggregates along with the market aggregates, between that and what people are feeling about the economy is very real. And I think that's important to understand. And it's sort of an IQ test, because if you look around and you say, is the world as good as it was, say, when consumer sentiment hit its peak in January of 2000? No, it's not. It's a lot harder today than it was. And the one thing I found around our holiday table, thing that we try not to talk too much about, is politics, because it makes for a hard holiday Thanksgiving. Everyone agreed that their discontent with Congress is at an all-time high. And so there really is a real dissonance, a cognitive dissonance. Even though we see a soft landing is not a no landing scenario. And we are starting to see some cracks in the foundation, but I do think, the consumer has proven itself remarkably resilient, and the rest of the world is looking for the U.S. consumer to remain an atlas. We expect spending to slow but not collapse as we go into 2024 by the U.S. consumer. That is a very important scenario, because if the U.S. consumer does not fully collapse and hit that contraction, a full-blown recession, it does mean that the U.S. economy will achieve a soft landing. But a soft landing does not mean, like I said, no landing, and that is still a rise in the unemployment rate. And so a soft landing in the aggregates is still hard for some.
But that also assumes, Diane, that inflation just, keeps gliding down to the Fed's target where it feels comfortable enough to keep stopping and then cutting interest rates. Is that sure to happen? We're going to get a PCE number on Thursday, and the Fed speak,
which will look
so
cool.
far, they're pushing back. They're saying, look, we may have work to do.
Well, they're pushing back because they want the bond market to do some of the heavy lifting for them, and they'd like to be done with interest rates. We are only done with interest rate hikes if, in fact, the bond market doesn't rally too much and we don't see bond yields come down so much that they actually stimulate growth again. And so this is something we're going to be watching very carefully. I think it's very important that we listen to Fed speak, because they're going to have a chance in December of whether or not to put an additional rate hike in their forecast, and that may be something they want to communicate if the bond market continues to rally and they get worried about inflation not just coming down. They want it to stay down below 3%. We're still not below that threshold on core inflation. They want to get there and stay there for a period of time, not months but quarters, before they cut rates. And even then, the descent on rates is going to be much slower than the ascent, which I think, I keep talking to people saying they're waiting for everything to go back to normal. Well, what was normal? The 2010s were not normal. And I think that is something that people are still coming to terms with.
It does feel like December, the meeting in December, I think the 13th, gives them a sort of cheap way to reset guidance, because they get to put out the dot plot, the SEP, the forecast for next year, and they could just, keep it high for all of next year, push out the idea of rate cuts, as you say, add even in a rate hike. Do you think that's a risk for the market, or is the market just going to continue to dismiss that?
I think it is a risk for the market, although, there is this sort of, tug of war that we're seeing between the Fed. The Fed likes the idea of a soft landing. The Fed is delighted that, they really believed we were going to get a recession, and I believe them too, and we haven't gotten it yet. That doesn't mean no landing and no turbulence. And we are starting to see it in delinquencies. We're starting to see the delinquencies move up the food chain from subprime into the third quintile of incomes. Now that's 50,000 to 75,000. earning households that still isn't in those top echelons that Bob Pisani was vacationing with. But I think it's important to remember that this is where we're going to see the belt tightening occur in the U.S. economy.
Thank you, Diane. Really good to have you today to help preview what's ahead. Diane Swonk.
She's not going to be haranguing beachgoers at the bar, I don't think.
Much calmer than that. Does Bob ever come back from vacation without like some great insight and color that he works into his reporting?
That's what he does. Vacation is just work for him. Yeah. All right, up next, check out this mystery chart. Stock's hitting a new 52-week high. In fact, it's up more than 30% this year. You can see 34.7%. It just got a new street high price target this morning. Imagine that. Yeah, and we are going to reveal what stock that is. And get this, we're going to talk to the analyst who made the call.
Cyber Monday.
All right, we showed you that mystery chart before the break. It is Pinterest, as you see there. Shares did hit a new 52-week high right now. And the stock got a new street high price target as well. Our next guest initiating it with a $48 a share price target. New Street research analyst Dan Salmon joins us now. Why, Dan? Why do you like it, and why is it going higher?
Thanks, David. Morning. So a lot of people are focused right now on what Pinterest is doing with Amazon, where they're partnering with them to help Amazon bring in more ad buyers and more targeted ads to their platform. Lots of focus on that. That's a big positive for them, big driver of revenue. The thing we don't think people are focused on enough is the fact that they're going to be able to save money on their sales expense by partnering with Amazon and bringing in other partners later. We just think it's something that's underappreciated. Management has talked about it a little bit, but not a whole lot. And that was really the focus of the bullish outlook that we started the stock with this morning.
Do we have any data yet on sort of where these third-party ad partnerships are, and or what are your expectations in terms of the growth?
So not a whole lot just yet. Amazon's the first one to launch. They're just doing it in the US right now. Management has said that they're relatively happy with the test so far. I'm sure we'll find out, and they saw a lot more progress from it here over the beginning of the holiday shopping weekend and through the end of the year. They expect the partnerships to start to become a little bit more material starting next year. And like I said, we probably expect them to expand it beyond the US, as well as add partners in addition to Amazon. In terms of total revenue growth, we're pretty much in line with where their guidance has been, which is mid to high double digits over time. We just think these third-party partnerships can be pretty material, and in the next 5 years, we think that they'll come to make up about 50% of their total revenue overall.
Doug, is generative AI a threat or an opportunity for Pinterest?
I would say mostly opportunity right now. It's not a huge focus for them. It's not as significant as it is with the big guys like Google and Meta and Amazon right now. They have some pilot tests right now, for example, to create generative search guides to help users when they're on the platform. They've launched a tool called Creative Studio, which is going to help advertisers create customized ads to create more personalized ones for individuals. Both of those things are kind of similar to what we've seen from the other big platforms. It is a searching platform. It is a place where people come to ask questions. So we think generative AI and chatbots is really important for Google and their search business. We do think it's important for them as well, but the visual nature of the platform is a little bit differentiated for them. So still early in their journey for generative AI right now.
Dan, thank you.
Okay, thanks, guys.
Dan Salmon from New Street.
Dan, called him Doug by accident. Sorry, Dan. Turning to crypto, Bitcoin in the red this morning, but still up firmly on the month. Let's get to Kate Rooney with some headlines you may have missed. Kate.
Hey, Sarah, good morning. So the big headline in this industry has been the fall of another crypto titan, this time Changpeng Zhao, also known as CZ. He stepped down as the CEO of Binance last week. He pleaded guilty to money laundering charges, and it comes after FTX's Sam Bankman-Fried was found guilty of criminal charges last month. CZ is now asking for a judge's permission to leave the U.S. before sentencing in February. He holds dual citizenship in Canada, and the UAE. CZ's lawyer is now saying, quote, the fact that his home and his family are in the UAE does not make him a flight risk. Preventing him from returning to them would be punitive, as they put it. His company paid a record $4.3 billion fine last week, and that settlement came after a 3-year investigation from DOJ, Treasury, and the CFTC. And then the SEC, for its part, has sued multiple crypto exchanges for civil charges. That includes Coinbase. Coinbase's CEO, Brian Armstrong, though, telling me that a shakeout of some of the criminal behavior in crypto and what he called bad actors in the industry, he sees it as a good thing. Also says it allows the industry to, quote, turn the page. Investors, meanwhile, say that guilty plea eliminates some of the uncertainty in these markets. You can see Bitcoin pretty much held up amid that news, still above 36,000K, at least this morning. Guys, back to you.
All right, Kate, thank you. Kate Rooney. Coming up at 11, the CEO of online marketplace StockX, his read on the consumer and a real-time look at the brands that are winning there. He joins us next hour. Do not miss it. Dow's down about 54 points. Don't go anywhere.
50% off.
Welcome back to Squawk on the Street. So just a year and a half after hybrids fell behind EVs in new vehicle sales, leadership in the race has changed. Phil LeBeau joins us to explain why, Phil, and what the data is showing.
Well, the data shows that hybrids are hot, Sarah, and everybody, you talk to them in the industry, almost everybody says the same thing. Automakers, with the exception of a Tesla and a Rivian, whoop, how's this?
Yeah,
That'll be better.
There you go. All right, let's show you the data. Here's the hybrids in terms of their relativity to EVs and ICE. By the way, internal combustion engine vehicles, they are now under 80% on a monthly basis. This is year-to-date data. We'll continue to see that erode over the next several years, no doubt about that. In terms of hybrids, the announcement from Toyota says it all. A week and a half ago, they said we're going to make only hybrid Camrys. And when they made that announcement, everybody said, makes sense. Look at the RAV4 hybrid. Look at the other Toyota models that are red hot right now. Toyota and Honda have long said hybrids are where they're going to make their money, and they have been incredibly successful. Take a look at these two stocks over the last year. At a time when a lot of the automakers are struggling, they are continuing to have pretty successful years, and shareholders are rewarding them. One other stock I want to show you, Ford. The F-150 hybrid. I know we talk a lot about the Lightning, but the F-150 hybrid sales are up 46% in the third quarter versus last year. So what you're looking at is hybrids are where people want to go. The EVs will eventually surpass hybrids. That's going to happen. But for the foreseeable future, and I mean maybe the next year, year and a half, 2 years, because so many more people will be buying hybrids, that's where you're going to see the growth in terms of sales versus EVs.
Right. All right. But why? Why do we think that's the case, Phil?
Couple of things. One, far cheaper. The average hybrid sells for $41,000, David. The average EV sells for $51,000. Until you see EVs come down under $40,000 consistently, you're going to see hybrids become much more attractive. And two, there's charging anxiety. A lot of people are like, look, I like getting some EV benefit here, but I'm not crazy about the idea of going completely electric.
Yeah, I could imagine that as well. Just the infrequency of finding the right place and how long it takes as well. Phil, thank you.
It's really annoying for road trips.
It is?
For road trips, especially if it's cold outside and raining, you have to charge, and it takes half hour, 40 minutes.
Yeah, don't
some
count me in.
anecdotal data.
No, I hear you. I hear you. All right, we got a lot more Squawk on the Street for you straight ahead. Don't go anywhere.
Cyber Monday.
Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Mike Santoli. This morning, Carl's on assignment. Airlines grappling with pricing. Are more fare hikes on the horizon? The former Continental CEO is with us, along with Raymond James airline analyst, with his picks.
And former Energy Secretary Rick Perry on why the market is so concerned with OPEC's next move, despite record U.S. crude production.
And the CEO of StockX, the latest Cyber Monday numbers. That's after $9.8 billion of online spending, set a Black Friday record.
Take a look at the markets right now, hovering just below the flat line on the S&P 500. The Dow down 60 points. NASDAQ, though, is firm. It's right around flat, just barely green. Amazon, one of the upside leaders on the NASDAQ. We also, Sarah, getting a number of 2024 outlook notes published today. BMO and Deutsche have 2024 year-end price targets of 5,100 on the S&P, while Wells Fargo says the index could reach 4625, just up from here. BMO saying it's enthusiastic about stock market potential heading into 2024, while Deutsche's base case incorporates a mild short recession, kind of saying that the stock market can probably power through that. It's interesting, the setup, I think, because the market has kind of passed by the sell-side strategists on a year-end 2023 basis.
Yep.
If you look at where the aggregate target is relative to where the index is, the index is actually a little bit ahead of it. And so I think there's a catch-up move by strategists. So 5,100, that's about 12% up from here. It certainly would be a new high. 4,800 is the old high, but it would only be up 6% over 3 years from the prior peak at the beginning of 2022. So it's mild
upside, I guess.
It's somewhat mild upside, yeah.
But I keep thinking back to this time last year, the 2023 outlooks, everyone was negative. They thought the market can't possibly go up. We've had all these rate hikes. Record timing of rate hikes.
That's right.
Some of them were quadruple rate hikes, and so we're going to feel it in terms of an earnings recession, which we got a little bit, and an economic recession, which we very much did not get.
Exactly. No, that's a tremendous contrast.
Too positive on 2024?
I think it's a little more mixed. I think that people have been kind of chastened by the fact that the recession everyone saw 12 months ago has not yet come. We have pulled out of that mild earnings recession, so I do think it's an interesting setup. I would agree with you, though, that it's not as if everybody's fighting this move, this rally that we've gotten this time. So
soft landing is still consensus,
that's right.
Wouldn't you say?
It's looking exactly.
Although when
like
I pushed back on Tony Dwyer of Canaccord about he expects recession, I said, well, that's not in the price. He said, well, if you look at the average stock, it kind of is.
It is. It's sort of the rejoinder to it's only 7 stocks going up. Well, that means the rest of the market is assuming that maybe things won't be so great in the economy. Well, our next guest is focused on the inflation backdrop for 2024. He sees the U.S. And the UK central banks both not looking to cut rates anytime soon, with the pound at a 3-month high versus the dollar and the U.S. dollar index at a 3-month low. Instead, looking at precious metals and other commodities heading into the new year. Joining us now, Blakely Financial Group Chief Investment Officer and CNBC contributor Peter Boockvar. Peter, good morning.
Hi, Mike. How are you?
Good, thanks. The last little up leg in the stock market started with the CPI report for October, which was on November 14th. It seemed to get everybody on board with this idea that disinflation is well in train. You had the bond yields on the 10-year Treasury back off from 4.6 down below 4.5. So that seems to solidify this idea that inflation seems like it was 2022's problem and the Fed is done. Do you take issue with that?
No, not right now. I mean, certainly the moderation is also lending support to the belief that the Fed is going to cut interest rates by 100 basis points through the end of next year. And I think that is also a major catalyst for the stock market rally, because who, after all, doesn't want to miss a Fed is done rally? I think the real question with inflation is after this moderation, because that's what happens. You get an inflation spike and you get the come down. And where does inflation, though, eventually settle out at? Because that's going to be a key determinant to the extent at which the Fed can continue to can start cutting interest rates. But at the same time, though, the monetary tightening is continuing via balance sheets. QT, not just in the U.S., but around the world. And just by keeping interest rates high for a while is its own continued form of tightening, because eventually somebody's debt is coming due and is going to have to reprice at a much higher rate than the rate on the loan that's coming due.
Right, which is, of course, to some degree by design. That's what the Fed has been trying to restrain the economy along those channels.
Correct.
I guess the question is, how fast does inflation have to get toward the target? The Fed's own published outlook is not anticipating getting back to 2% until after next year, and yet the consensus outlook was also that they would start cutting rates. So it seems as if, if you have this general idea that moderating growth but not a plunge into recession is what we might have just ahead of us, the Fed might be cutting into that, at least on a kind of short-term basis, or at least sort of those insurance cuts people talk about.
Well, also the Fed's going to be, I think, at some point, and I think it's going to be 2024, where they're also going to be looking at the unemployment rate, which is all of a sudden near 4% at the highest level since early last year. That is going to also, I think, become part of the conversation. And it's on the inflation side, it's very important. Just because you have a 2 handle on a particular month next year doesn't mean that the inflation battle has been won. It's a sustainable level of 2% that if the Fed is most focused on, not just 1 or 2 months here and there that we see that. Even if we have a 1 handle, it's where does inflation on a multi-year basis eventually stop at? And I don't think it's going to be 1 to 2. I think it's going to settle out at 3 to 4, even though we're still going to get some 2% prints. And one thing with the labor market.
Oh, go ahead.
Sorry. No, one thing with the labor market. We saw in Friday's U.S. PMI from S&P Global, they said the services employment component dipped below 50 for the first time since 2020. So keep our eye on further softening in the labor market.
Yeah, I was just going to ask Peter if that's what you're getting from some of the commentary, because you put together a lot of what we get from corporate America, and I'm curious what your threads you're picking up on inflation and demand and whether they match the market expectations.
Well, the demand side, at least on the consumer end, is very bifurcated. Obviously, the upper income consumer is still spending, although from Burberry, from Richemont, we're hearing some signs that maybe even the upper end consumer is moderating some of their spend. And the lower income consumer is clearly focused on just getting by and focusing on the stuff that they need rather than the stuff that they want. In terms of inflation, there's no doubt that it's moderating. It's going to continue to next year as the rent slowdown works its way through into the CPI stats. But again, after that fall back in inflation, are we just 1 to 2% magically going to stay there? Because there's one thing for the Fed to get inflation down. There's another thing for the Fed to keep it down.
Well, sure. But it seems like from the market's horizon, we'll figure that out another time, right? I mean, the Fed was missing its target to the downside for a decade, and the markets sort of found their way around that.
You're right. I think that the market is very focused on the optimism that inflation's moderating and the Fed's done raising interest rates. And nothing else right now matters. The economic slowdown that I think in certain pockets of the economy are happening doesn't matter. An earnings recession this year didn't matter. It's when is the Fed going to stop raising interest rates seemed to be the sole focus of markets this year.
So what do you like right now, Peter? You've liked gold, some other hard assets in the past, certain stocks maybe with defensive characteristics. Is that your playbook?
It still is. I think when you look at the safety trade, so to speak, over the last couple of years, it's been precious metals, particularly gold, more so than silver, and it's been energy stocks. And I think that theme continues. I add in uranium, I add in copper, some of those other commodities that I think will outperform. And I'm also very bullish on Asia. I know the whole world is bearish on China. I think when you look at the Asia region in totality, you've seen some bright spots like Japan. I think the Hang Seng Index is going to outperform the S&P 500 over the next 12 months. And it's not just a play on a Chinese recovery. It's a recovery in the entire region of Asia, particularly Southeast Asia, too, which stocks in the Hang Seng can benefit from that.
Yeah, as you mentioned, so far Japan has been the favorite there. We'll see if it has any followers. Peter Brookvar, appreciate the time. Thanks again.
Thank you.
Up next, former Energy Secretary Rick Perry. The U.S. is currently producing more crude oil than at any time in history. So why are we so concerned with OPEC's next move? And is it impacting commodities prices? WTI on pace for a second straight down month.
Plus, how have rising fuel prices hit the airline industry, and can the market sustain the recent decline in off-peak fares? We discuss all of that when Squawk on the Street returns.
CrownCastle.com.
Crown Castle on the move this morning after the Wall Street Journal reported the activist investor Elliott Management has accrued a stake of more than $2 billion in the company, good for more than a 4% stake, and looking to make changes to boost the stock. Shares of the wireless tower operator currently up about 4.5%.
The energy market continues to be in focus as crude and Brent both fall following OPEC's decision to postpone its meeting. While much of the attention is being paid to OPEC, the real story may be here at home. According to new numbers, domestic production has reached 13.2 million barrels per day. That's the highest output in history. Joining us to discuss the state of the energy market is former U.S. Secretary of Energy and Governor of Texas, Rick Perry. Secretary Perry, it's great to have you on. That beats the Trump era milestone of energy production in this country. Are you surprised?
Not necessarily. Hats off to the innovators and particularly the Texas oil and gas producers who are out there producing at record levels. You know, if you're from Oklahoma, North Dakota, those two states are down. Alaska's taken a real hit. You know, in the U.S., we've seen some really great development in the oil and gas industry, and particularly in Texas, as I said. So it doesn't necessarily surprise me. It could be substantially better if you had an administration that was supportive of fossil fuels. This current administration's not. And we've seen offshore leasing cut substantially, federal lands cut substantially. So we could even be higher if we had the support of the federal government. But, you know, even without that, the private sector kind of shrugs them off and goes on about their business because the demand's there. And I think that's the real key, understanding that the demand worldwide is there. You got the conflicts in Ukraine and in Israel that's also affecting the world. So a lot going on out there, but thank God that the American oil and gas industry is as resilient as it is. Here's the problem with the message that we're getting out of this administration long term for refineries and those types of infrastructure that need to be built out for the future growth. It may not be happening, and that's my big concern.
Right. Well, they're trying to straddle this idea of we need oil production at the moment, but in the future we need to look toward a more sustainable future, especially as the COP meeting kicks off. Secretary Perry, is there a way to do that? Is there a way to do both?
You know, we'll see. I just think it's short-sighted and kind of a fool's errand to not believe and understand that you're going to have fossil fuels way into the future. Are electrics fine, or the minerals, or the rare earth minerals and all of that's going to be required? Have we really thought that through? Just how big a shovel do you have to have? My friend Dan Yergin just wrote a very interesting article about the big shovel and how much of these rare earth minerals you're going to have. And do we have it? I mean, what's the impact on the earth, so to speak? And those are really good questions that haven't been answered appropriately, in my opinion. So we'll see if we can split this baby and do it. But don't get confused. You're going to need fossil fuels for literally decades into the future to have the base load electricity. And you better get focused on nuclear power, small modular reactors in particular, to be able to fill that base load electric power need that's going to be out there in the future.
Yeah, that's something that gets a lot less attention, at least at the moment. I do wonder, though, given the North American production being at these record levels, and they postponed the OPEC meeting seemingly because they couldn't come around to an agreement on further production cuts. I mean, this is the way commodity markets are supposed to work, right? It's a commodity. If one is producing more, it's tough to sit it out and wait for higher prices. So it would seem like good news globally.
You would think that's the case. So, we'll leave OPEC to their business deciding what they need to do on theirs. Hopefully the U.S. will continue to produce at record levels, and we can fill any needs that the world has for the energy development that is going to be required for growth. I mean, if the world is growing, there's great need for this fossil fuel out there. So let's celebrate that instead of sticking our head in the sand and saying, oh, we got a existential threat here with the climate, and I expect we're going to hear a lot of that with COP. But reality is, if you want to have the lights on, if you want to see the world progress, I mean, the message of net zero to African citizens, the people who live on that continent, is sorry, you're not going to have progress in your life. You're just going to live the way you're living. And I think that's a very racist message, as well as one that's very negative.
I'm curious, Secretary Perry, what's happening with Iranian production and exports and what we know. Just looking at, a report from the United Against Nuclear Iran, the group of former politicians and Senate ambassadors, Iran exported nearly 1.4 million barrels of oil per day in October, sustaining its average for 2023. Do you think that's what's happening, and is it a mistake? Is there more pressure the U.S. administration should be applying right now?
Well, I certainly think that the pressure should be applied to those individuals, and particularly in the oil and gas side of it. They're funding the terrorist attacks across the world. They're Hamas, Hezbollah, the Houthis, all of those groups that are attacking Western civilization, if you will, Western values around the world. The Iranians are at the core of funding it. And Iran gets their money basically through the oil and gas industry. So this administration has sent pretty mixed messages, in my opinion, to the world about how we're going to deal with Iran. And they're wrong. And there are people paying with their lives, and that is unconscionable. And this administration needs to use substantially more leverage against Iran.
Where do you think energy policy is going to be a big issue for the 2024 election? It feels like it was more so when inflation was really spiking and people were feeling it more at the gas pump, but it's come down a lot.
Well, energy policy is going to be at the heart of any election. It should be. The idea that if you lose your ability to have an energy policy that is progressive, to have baseload electricity, you want to see chaos in the world, lose your electric grid. And if the only way that you can have a stable electric grid is with fossil fuels and with nuclear power, you can't do it with just solar and just wind. They're nice additions, but you can't do it based on that. And so net zero, just on its face, I think is going to be a failure. But in this next election cycle, energy policy will be at the core, I think, of decision making about whether we want the current administration or we want another administration in place that has a little more progressive, thoughtful, and frankly, realistic approach to energy policy. And that is having baseload electricity so that our power stays on, our grid stays up.
We want the power to stay on, for sure. Rick Perry, thank you very much for the perspective today on those record numbers out of the U.S. Rick Perry, former Energy Secretary.
All right, later this hour, $9.8 billion. That's how much U.S. online shoppers spent on Black Friday, setting a new record, according to Adobe.
The impact for companies like Affirm, Shopify, Block, and PayPal is next as buy now, pay later use jumps 47%. We're back in 2 minutes. European market set to close in just a few minutes. Stocks are mostly lower, but off the worst levels. Defensive groups like real estate, utilities, and telecom, they're leading today, while cyclical stocks are lagging. European markets have closed higher for 2 straight weeks. UBS saying today they still see a slowdown and equity weakness on the horizon for Europe, and called 2024 a stock picker's market. ECB President Christine Lagarde speaking earlier today, saying headline inflation may tick up again in the coming months, and it's not time to start declaring victory and reducing inflation. She's spoken a lot lately, and she's continuing to hammer this message, as I think we're going to get from the Fed speak as well this week, and potentially even Powell later in the week. Calm down a little bit. Chillax, as Tony Dwyer would say. Cool your jets on this excitement that inflation is just going all the way back down. The central banks are done, and we're going to start cutting soon.
Sure.
I think they want to quiet some of that.
A little more
excitement.
stark when it comes to the ECB, though, right? With the sole mandate on inflation and the fact that they, because of that, almost have to tolerate more domestic weakness in the economies if that's the way it goes. And so, you have that message that's similar to what maybe the Fed is going to voice when it next meets. On the other hand, they don't have the same economic resilience, it seems, in terms of their economies.
No, and it does feel like they're willing to tolerate more, as you say, because of that single mandate. And they're not at the 2% level. It's come down.
Right.
It's not like a 15-year low, but
Sure.
it's...
Even though many people feel as if that maybe disinflationary forces are pretty strong in Europe still. So see how that goes. We are about 2 hours into trading. Let's go post to post with Bob Pisani for what's moving this morning. Hey, Bob.
Sort of a flattish open, but a spectacular November, and we're really heading into one of the best months we've seen in a number of years. I was joking earlier, I was at a fancy island in the Caribbean, and a lot of people were spending a lot, but seemed very worried. People were still spending in the United States here. If you look at the earnings commentary around the restaurants, generally they've been very good. Look at Chipotle here. It's just been on a tear all month. They had the earnings out at the end of October. It's been straight up. It was $1,900 at the end of October. Look at this, $2,200 right now. By the way, they've never split the stock ever. That's why this is a $2,200 stock. But what, up 15% this month? All the restaurants had decent numbers. McDonald's, the same thing. They reported around the same time as Chipotle at the end of October. Was $260, now $282. A big thing that's happened is not only do they have decent commentary, but rates went down the start of November, and that's really been the impetus around getting the stock market going here. So look at Target here. Target's over here. They had earnings commentary, not bad. In the middle of November, it was 110. Now it's 131 here. 2024 earnings estimates have been rising for the last couple of weeks on these, and that's been a big factor here. But again, rates coming down is the key story. If you look over here, let's look at something. Here's Sherwin-Williams, okay? Sherwin-Williams had an report. Overall, didn't do much. People weren't very impressed with it. This was right at the end of October. What got this thing moving was when rates started moving down in the middle of November. So put this back up. At the end of October, Sherwin-Williams was somewhere around 240. And look at it now, 274. Was it because the earnings were amazing? No, it's because rates moved down. And of course, this is a remodeling story. Maybe you get home building or home sales moving a little bit more. When the rates come down, they would be a beneficiary. So this is almost entirely a reduced interest rate environment report. Same with the REITs. All the REITs have been rallying since early November. There's Simon Property. Simon Property was, 105, 106, I forget, in the beginning of November, now 121. Again, this is all an interest rate play. So the only sector that's not doing great this November as rates come down has been the energy sector. And that's happening because oil's down and natural gas has been collapsing as well. And again, this is generally, here's SLB. This is the old Schlumberger. Now it's called SLB. It tends to follow, Sarah, as you know, these oil service names tend to follow oil prices. So oil peaked in October. Schlumberger peaked in October. It's been down maybe oil's down maybe 17, 18% since then. Schlumberger is only down 11%. And Sarah, the reason this happens is it tracks oil, but not perfectly. And the stock market's been moving up. So Schlumberger is a stock. It's been beneficiary of the fact that the stock market's been a little stronger. Same like gold stocks. They don't perfectly track gold. They generally track gold. Same with these oil service names. Sarah, back to you.
Yeah, makes sense. Bob, thank you. Bob Pisani. Time now for news update. Silvana Hanau has that for us. Silvana.
Hey, Sarah, good morning. Humanitarian aid trucks have started to arrive in the Gaza Strip under protection of the temporary ceasefire in Gaza. Sources tell NBC News Israel and Hamas are finalizing details of a truce extension, but they warn it could still collapse. Some 200 trucks are set to continue the delivery of supplies of food, water, medicine, and fuel to the region today. The motorcade for late First Lady Rosalynn Carter departed from Plains, Georgia this morning. It will eventually travel to the Jimmy Carter Presidential Library and Museum in Atlanta, where members of the public will be able to pay their respects to Carter before her funeral on Wednesday. Her husband, the 99-year-old former President Jimmy Carter, has been in hospice care since February. And the United States, Britain, and more than a dozen other countries signed an international agreement to protect the greater public from potential misuses of AI. But the 20-page document is non-binding. It includes general recommendations such as monitoring AI for abuse and vetting software suppliers. Sarah, back to you.
Silvana, thank you. Silvana Henao. Up next, all 6 of the major U.S. airlines saying their stock prices dropped last week over one of the busiest travel periods of the year. Only United and Delta positive for 2023. Can the industry sustain the current demand levels? And what will that mean for earnings and ticket prices? That's coming up after the break.
%50 off.
Shares of Foot Locker down marginally this morning as Citigroup slaps a sell rating on the stock. Weak macro, weaker comps, and poor timing for a turnaround, all catalysts behind that downgrade. The stock's already been having a rough year, down around 40%, including today's move. But off the earlier lows, one of the points that the Citigroup analyst made in this note, Mike, is that the turnaround is hard for Foot Locker itself to control its own destiny because 64% of its sales are exposed to Nike.
Exactly.
So it really just a lot of it rests on that relationship, and we know Nike has been cutting dependence on wholesale.
Yeah, the
partners.
long-term trends are not friendly. Yeah, it was a $60-something stock a year and a half ago. Now
Well, people were really
23.
excited about Mary Dillon,
Yeah.
and it's they got also disproportionately hit by the weaker consumer spending at the lower end, where
Right.
they have a lot of exposure through the malls.
Yeah, for inventory and promotions. All right, well, air travel keeps soaring. The TSA saw nearly 3 million people pass through checkpoints yesterday. That was a new single-day record. That comes after the agency already saw 7 of its 10 busiest days in its history this year. As fares fall and consumers are eager to travel, can airlines keep up the momentum? Joining us now to discuss, former Continental Airlines CEO and CNBC contributor Gordon Bethune and Raymond James airline analyst Savi Saith. Good morning to you both. Savi, just interested in how the stocks, which are 30% off their highs as a group. They trade, Delta and United trade at 4 to 6 times earnings. Market seems to be saying the good times can't last, at least in terms of profitability. What's your view on that?
I agree. I mean, that's definitely what the markets are saying. I disagree with the markets in that you have seen some fare weakness in the off peaks, but demand in the peaks have been really strong. And the airlines are moving quickly, as quickly as schedules allow, to adjust for those off peak periods. So I do think while it's not going to be maybe as strong in the transatlantic next year as this year, I think things are going to hold up better than the market appreciates.
Gordon, you know the old story, which is, that as a group, airlines have a hard time not adding capacity, not chasing volume once things slow down at all. You're starting to see some softening of price, as Savi was saying, in some areas. How do you think the industry is going to navigate this?
I think, on an overall basis, they're in a good position. They're starting to adjust, non-fare revenue to increase their margins. But they've got a lot of labor cost pressure on them now, which is going to be the real challenge for next year's earnings. But I generally agree that it's a positive growth scenario, but not extraordinary.
Gordon, how do you turn a good industry or a good operator and a good management team into a good stock? Because that always appears to be the problem here.
Well, people don't always read the tarot cards correctly either. And I think the management in the airline today is as strong as I've ever seen. So they're not a bunch of people chasing their own tail and attacking each other. They're staying focused on incremental revenue, which instead of day-night difference, it's just small margin increases with Wi-Fi fees and change fees coming back as they were before COVID. But overall, getting out of the 2020 hole, they're out of the hole now, and I think they're going to stay.
Savi, you mentioned the pressure on pricing in off-peak times and off-peak, I guess, routes, with not being compatible with current fuel cost levels. Now, it seems as if, obviously, the pressure has come off to some degree on fuel, but how is that playing out? What do you see that leading to next year?
Yeah, the fuel is still 50% above 2019, so it's a much better scenario than what you saw last year, but it's still a lot of pressure. And look, I think you saw some airlines this year in the third quarter not making money in this environment. So you are going to see airlines adjust capacity to address that, because the levels of fare that you're seeing in the off peaks is just not sustainable, and you're going to see it in capacity adjustments next year.
And which airlines, Savi, are, you think better positioned or at least more attractively valued in this environment?
Yeah, our picks is still, in this environment, Alaska and Delta, they have strong balance sheets to withstand any kind of slowdowns or shocks. And we think kind of doing the right things and earnings heading in the right direction.
I know, Gordon, you're looking at the election, the pending election, potentially for a driver of the economy or fiscal policy. I know it's not necessarily airline specific, but what do you expect?
Well, a lot of pressure there because, what the economy does is pretty much what the airlines are going to do. But once they get behind, as they did over the 2020 COVID, it's hard to catch up. So they're still adjusting on what the new day is here in America, or the international flights are showing some real growth. But the political issue is capital spending, and you're not just going to see capital spending in an uncertain environment. So we got to get behind the elections to see where we are.
And Savi, when it comes to just the macro influences on what's happening in terms of demand, on one level, you hear about the premiumization of everything and basically flyers willing to trade up for the sort of economy plus type fares. On the other, you see lots of pressure on certain routes and certain times. So is the consumer fatigue showing up in any of the numbers that you watch?
I think the biggest difference has been maybe on the margin, maybe there is some kind of returning to normal seasonality. Maybe there was a lot more kind of work from anywhere and taking advantage of flexible work schedules last year. You're not seeing it to the same degree this year. I think that's showing up. And just the premiumization, I think it's just more availability of premium product and better selling of the premium product is helping. So I don't think it's a reflection of the consumer. I think the consumer is strong. You just have more capacity and the travel patterns have returned back to what you saw pre-pandemic.
Yeah, it is tough to separate out the return to normal from cyclical pressures across lots of industries. Savi, Gordon, appreciate the time this morning. Thank you.
Thank you.
I wonder if there's any psychological impact about these increased hospitalizations for kids in China with this pneumonia. Yeah. I know that the health authorities there are saying it's, influenza, nothing that they don't recognize, but yeah, it hasn't been that long.
Well, Trans-Pacific has been very slow to come back anyway. I mean, but even within Asia, I would imagine that might have.
Right, they're seeing a surge in illnesses. Something to watch for sure. A jump in buy now, pay later spend, helping shares of Affirm this morning. Those new numbers after the break, with Affirm stock up more than 200% so far this year. Stay with us.
Cyber Monday.
We've got the results of this morning's two-year Treasury auction. Rick Santelli has the details. Hi, Rick.
Hi, Mike. Indeed, 54 billion two-year notes yielding 4.887 at the Dutch auction. The problem is it tailed by about 1 basis point. That really does hurt the grading. I gave the auction a C minus, a C minus. Let's go through the highlights, shall we? The bid to cover, 2.54, a bit light, lowest since March. If you look indirects, 57.4, lowest since March. Now, not that March was that long ago, but there was a huge pop in direct bidders, and that really helped. 23.9, that's actually the best since March. And finally, the dealers end up taking a bit too much, 18.8%. That's the highest amount since April. Their 10 auction average is 16%. As you look at the intraday chart, what is notable here is there wasn't a huge amount of volatility as the auction ended at 11:30, but we did see the market make a new low yield high price of the session, and that is something to pay attention to. It's most likely the mogul effect, the fact that the auction's now in the rearview mirror. But we're not done yet. We have $55 billion in 5-year notes at top of the one, and then tomorrow, $39 billion 7-year notes, completing the Treasury auction supply on this trifecta of $148 billion. Back to you, Mike.
Rick, thanks so much. All right, shares of Affirm hitting a 15-month high as Adobe estimates usage of buy now, pay later could reach record levels today. Kate Rooney has the details in today's Tech Check. Hi, Kate.
Hi, Mike. So buy now, pay later options are having a moment this holiday shopping season. These are also referred to as BNPL. It's essentially installment payments. For example, paying in 4 lump sums over time versus using a revolving credit card. They really rose in popularity during the pandemic for those big ticket items. Think of things like a new Peloton bike. Now, though, they're starting to show up in everyday spending. Adobe has some new numbers on that recent boom. For Black Friday, BNPL revenue was up 47% from a year ago. Today, Cyber Monday, it is expected to hit an all-time high. It's on track to contribute $782 million in online spending. That's up 18.8% year over year. And last week, 72% more shoppers were using BNPL plans compared with the prior week. And as Adobe put it, while consumers are showing a strong appetite to shop online, many are giving themselves more flexibility with their budgets and continue to embrace flexible payment methods. Affirm is that pure play leader in the space. It's hitting a 15-month high today. E-commerce in general also seeing a boost. You've got Shopify seeing global Black Friday sales up 22%. MasterCard's Spending Pulse shows pretty strong in-store and online retail sales. And while more spending, guys, could be seen as bullish and show some resiliency for the U.S. consumer, that BNPL bump could also be interpreted as a bit more negative. As Wells Fargo analysts put it, the other side of this, and especially married with this BNPL data point, it's more bearish. RE, the U.S. consumer being more price conscious given the inflationary backdrop and is opting to chase some of the more deals and discounts out there. Higher interest rates, guys, of course, are a part of this boom in BNPL as well. Back to you.
Yeah, it sort of fits with the whole value. Consumers paying more attention, a little bit under further stress, but it really comes down to delinquency rates. Kate, what are we seeing them rise yet in results of Affirm and other buy now, pay later stocks?
Yeah, it's interesting, Sarah. Not yet, and that's something that analysts really watch closely with Affirm. They have made the case that they're able to tightly control that they're able to pull back some of the issuing when it comes to delinquencies, and that they can sort of keep that in check. And they've said it's all tech related. They've got this algorithm that can help them with delinquencies. If we do start to see that pick up at all, it's really something to watch for the consumer. But so far, surprisingly, Affirm has not seen an uptick in delinquencies, and that's really helped the stock after earnings. It's been also highly shorted, so it's been one of those really volatile names out there and done quite well after earnings when they report a pretty steady line of delinquencies, but absolutely something to watch there.
Yeah, in theory, balances wouldn't snowball as they would with revolving credit, too. Theoretically, maybe more controllable. We'll see if that plays out through the cycle. Kate, thanks so much.
Thanks, guys.
After the break, sticking with Cyber Monday, the CEO of StockX is next with more on the latest numbers and trends from the holiday shopping season. We're back in 2 minutes. Welcome back. U.S. online shoppers set Black Friday spending records, according to Adobe. How's Cyber Monday looking now? Our Courtney Reagan is in a Walmart fulfillment center in Chino, California, with the latest numbers. Courtney, what's it like there?
Hi, Sarah. Yeah, so as you can see behind me, orders are just humming by. Walmart says they're really filled within about an hour of being placed here at this digital distribution center in Chino, California. A lot of top sellers so far. As a matter of fact, this Asda laptop, it was $1,000 off. It's already sold out. The Sony Bravia TV, among one of the things that is selling very quickly, as well as the Apple Watch. And for the first time this year, Walmart Plus members got early access to those Cyber Monday deals.
For our Walmart Plus members who get a 3-hour head start on those hot items, they'll be able to shop those items all the way through this Wednesday.
Captify says top searched retailers online so far this morning in order: Target #1, Home Depot 2, Walmart and Kohl's. All those seeing a search uptick from last Cyber Monday. And after a stronger than expected start to the Cyber Week, Adobe does now expect consumers will spend between $12 and $12.4 billion today, making it the biggest online sales day of the year, up about 6% over last year. Thanksgiving online sales grew 5.5%. Black Friday grew 7.5%. Saturday up 8.1%, and Sunday up 6.4% year over year. Now, the firm does forecast that this 5-day Cyber Week from Thanksgiving here through Cyber Monday will make up about 17% of total holiday online sales. And it's important to note that while Adobe data is not inflation adjusted, they say that the retail numbers and prices that they track are actually down 6% in October of this year from last October. So this uptick is indicative of higher demand. Back over to you guys.
Yeah, I was wondering about that because some of these numbers aren't inflation adjusted. Courtney, thank you very much. Let's take a closer look at the key trends that are shaping Cyber Monday and the holiday shopping season. Joining us now, StockX CEO Scott Cutler, which is a nice Cyber Monday tradition to have you, Scott. How is it looking from your perspective?
Well, on Black Friday, our trades surged by more than 200% compared to the previous week. StockX averaged more than one trade every second throughout the day. I think this year we saw a flood of first-time buyers on StockX. Black Friday was, in fact, the second biggest day in company history for first-time buyers, second only to Black Friday during the pandemic when people had normed to online shopping. I think this year, millennials are expected to drive 43% of spend during Cyber Weekend. And importantly, many of them are buying for themselves. But for that consumer, what we see in our market is that value is top of mind. Resale can be more affordable than retail. And this year, 35% of US sneakers, as an example, are trading below their retail price, which is a 60% increase over last year.
Is that just because of promotions, or is it because demand has weakened?
Well, StockX reflects the real-time supply and demand in the marketplace. And I think on one hand, you're seeing a consumer that is still challenged in terms of their buying power. And on the other hand, you're seeing supply come into the market. And I think when those dynamics play together, again, what we see is that resale premiums are down this year over last year. But we also see a lot of brands that are breaking through and grabbing market share and setting all-time records this Black Friday. For example, UGG, New Balance, ASICS, Fear of God, Birkenstock. These are all gaining traction as this younger consumer is looking to diversify their closets, but buying the right thing at the right price.
It's interesting, Scott, because I think there's a perception, at least I had the perception, that you are trading off of relative scarcity out there. And I guess if 35% of sneakers are trading below list price, 65% are above. So, I mean, is there still this idea out there that you do benefit from those hot items that the manufacturers either can't or won't keep up supply for?
Well, it's, when we look at the top moving brands this time on Black Friday and through this Cyber Weekend, I'll give you just a couple of examples. Nike Dunks, which is a popular silhouette. It's one of the most popular silhouettes over the last couple of years. We're seeing high volumes, but softer resale price premiums in 2023. For example, the Nike Dunk Low White Black Panda, very popular sneaker, retail price $110, average resale price around $100. So the most popular dunk, however, this year is a women's exclusive release, which is a Nike Dunk Low Photon Dusk. So I think what you're seeing again is the market value being represented in how much volume brands are releasing into the market, and then how much the consumer is willing to pay in resale.
Yeah, people are still buying Yeezys. I saw that on your list as well.
Yeah, so in the shoes category, outside of Adidas and Dunks, in shoes, Yeezy Slides are the #1 top traded product over the Cyber Weekend. The average resale price there is around $100, so lower than it had been in prior years, but putting them at a very affordable price point for many of the brand's sneakers. We also see character-inspired Crocs. This one's fun. 2 different Crocs clogs rank among the top 50 best-selling products. This is, going back to Pixar, the Crocs classic clog Lightning McQueen. Great purchase for a young consumer.
They're
or the
hard to
Crocs
get.
classic clog Vader. This is a get. This is something that you should have on your feet this holiday season.
I've tried with those Lightning McQueen Crocs. They're not easy to come by, Scott. Thank you very much. Always good to get a read from you on what's hot right now in resale sneakers of StockX. Meantime, Wall Street is buzzing about Elon Musk in Israel this morning. He's been meeting with Prime Minister Benjamin Netanyahu and visiting one of the towns that was devastated by the October 7th Hamas terrorist attacks. Musk visiting Israel as, of course, he's been under fire from several brands for increased hate speech and anti-Semitism on X. Reuters reporting that advertiser exodus off the platform may cost as much as $75 million by year end. And meantime, the White House just confirming in the last half hour or so that Hamas and Israel have agreed to extend their truce in Gaza, which hopefully should mean more hostages get released back into Israel. I'll see if they can follow
Certainly
that up. But as far as
yeah.
X, look, I think Musk himself tweeted actions speak louder than words this morning. And I think the fact that he is there, it'll be interesting to see whether the X policies change because there is a ton of hate speech, anti-Semitism.
Absolutely.
It's a cesspool.
Well,
and it's not just X.
It's only a good thing if somebody can go and find out more firsthand about the issues and what's behind it, as opposed to just firing off
100%.
a viral tweet. And Musk's own virality on his own platform, his incentive is to stoke whatever travels. And I think that could be a bigger issue longer term for the model. Yeah.
Interesting first step. He said it's been an emotional day, no doubt.
Sure.
Well, looks like, Mike, market.
Hanging in there.
Not
Yeah,
doing
holding
too
on
bad,
to the 4 weeks of gains, I guess you would probably say. Yeah.
It's been quite a November as we head to
Yes.
the end of the month. We'll
For a
see if
couple
the
more
gains
days.
can continue. With that, we'll send it over to Scott and the halftime report.
All right, Sarah, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, on pace now for the best month in 2 years. So how far can stocks run? We'll debate that with the investment committee today. Joining me for the hour, everybody's here at Post 9. Joe Terranova, Stephanie Link, Jason Snipe, BMO's Brian Belsky. Let's take you to the market. It's been a bit of a choppy day. Dow is red, so is the S&P. NASDAQ a little bit positive. There's 442 on the 10-year. Joe, discretionary and tech are the only positive sectors of the day, but we are on track, as we said, for the best month in a couple of years. Let's look at the VIX, too. Under 13.
Yeah,
12.7.
Remarkably, this pattern that's been in place for the entirety of November, where if you have any type of dip, the market seems to stabilize and then resume the prevailing bullish trend. And I think we saw a little bit of that this morning. You had some early weakness in the NASDAQ. Apple, NVIDIA with both down. That's been washed away. Apple and NVIDIA now have turned, and then they're now in the green. So I think what's important is to understand that overall trend for the month, and I think that gives a strong degree of confidence that the high for the S&P back in July at 46.07, that intraday high, that seems to be the target of where we're headed in the coming weeks.
All right, Steph, so are we going to get there and then beyond?
Yeah.
It's been one heck of a month, and things seem to be going according to plan, right?
Yep.
Black Friday's strong, so the consumer's still spending. We're still, some would suggest on pace for that soft landing, which, many thought was elusive some 12 months ago, but here we are.
Yeah, a lot of things are going right now, right? Inflation is lower. Interest rates are lower. The economic data is running at about 1.5%, 2% in GDP. Not a disaster, not as strong as 3Q, but certainly holding its own. And then the big change in the last couple of weeks is oil. I mean, oil's down 20% from their highs. And that means that the consumer has something like $54 billion in pent-up potential spend. And that actually, I think, is going to, not all of it's going to get spent, but I do think that's a nice tailwind. So I still think the consumer's hanging in there. I think they will, and that's a big part of the economy. So I'm pretty bullish.
Yeah, how much room do we have, Jason, for this run we've been on?
I think we still have quite a bit left, honestly. I think, the one thing I will say is I think we're slightly overbought in the very, very near term. But I don't think that has any bar on a run into December, right? Because I think one of the things that we haven't mentioned yet is Chase is still there. There's a lot of money managers that have not done well throughout this year. We've talked about the Magnificent Seven all year. Equal weight, S&P. There's a lot of folks that just haven't returned, and I think that Chase will come into play towards the end of the year, and I think that's why I'm stay positive.
It's interesting, Brian, whether if there's a fair amount of cash on the sidelines, been sitting in money markets for as long as we can remember at this point, whether that's bullish now for both stocks and bonds, right? Because if money's going to come out, where's it going to go? It doesn't necessarily go just into equities, because there are those who suggest that bonds are just as attractive right now as stocks are, if not even more so.
That's right. I think private wealth has done an amazing job running their portfolios this year. And, a lot of the higher net worth private wealth people have products where you can have a 5.5% money market account. And, we've been saying for a while that we're entering a period where you can, will, and should own both stocks and bonds, especially considering that we're coming out of this 2-year period, Scott, as you know, of negative real rates of return in bonds for the first time in over 40 years.
You seem a little subdued over there. You all right? Traveling over Thanksgiving weekend.
Listen,
got you down. I mean, because you shouldn't be subdued with a 5,100 base case for next year for the S&P. I'm wondering what your bull case is.
5,500.
Okay. How are we going to get better than 10% minimum?
Well, how we're going to get there is that we see a really rapid drop-off in inflation. We see earnings just take off, and GDP holds in there a little bit better than we thought. And so I think from a 5,100 number, that's for our 5,500 number. For our 5,100 number, which is our base case, inflation rolls over, recession in name only, not a technical recession. Rates stick around 4% for the first half of the year, dip below 4% the second half of the year. The market broadens out. We're going to be in a market where you should own both growth and value. And in terms of size and style, I like to call it the Jackie Moon market. Own everything, ELE, right? Everybody love everybody, meaning small, medium, and large together.
Own everything. So everything's, we're in
equal weight everything. Equal weight everything. Don't be massively over large. Don't be massively over small. Own a combination. So what that tells you is get smaller overall, right? Because if you take a look at equities in general, equity positions are way underweight small cap. So you need to build those positions in small cap.
Speaking of over, I mean, you're not over your skis at all on the idea that you're going to have your words, really rapid drop in inflation. I mean, inflation's come down.
Yep.
There's nothing necessarily to suggest that it's going to go into some hyper decline from here, though.
No, I mean, if you get down to 2% faster than everybody thinks in the first half of the year, to get to 5,500, yes, I think it's going to continue to be a steady decline, and that's what keeps us at 5,100. So still, if you look at a second year of a bull market, it's roughly 11.5%. If you look at the second year of normalization, which we're calling this high single-digit, low double-digit returns, this is very positive for the whole secular bull market that we've been talking about.
So you think we are undoubtedly in a bull market, in a new bull market?
I said this 14 months ago. I'm sorry to say that I said this a while ago, but I said October of 2022 is the start of the bull market. Everybody doubted it all year long. It was walking the wall of worry, climbing the wall of worry. Now we're starting to get better participation. I think that's going to follow through into year 2 of the bull market, which is next year, part of a cyclical bull, part of our longer-term 20 to 25-year secular bull market.
Yeah, but you can't be, I mean, you're trying to claim credit for being like a super prognosticator of a market that did next to nothing other than 7 stocks.
No, well, hold on a second. If you're looking at how things are looking on a fundamental basis with respect to cash flow, earnings growth, and balance sheets, pristine with respect to cash flow and balance sheets, and earnings have become very stable. If you look at other names, what about Delta? Okay. What about United Airlines coming up recently? What about some of these other names in the housing market? The housing industry was the second best performing industry after technology. There are other names besides the Magnificent Seven. You look at some small cap banks up 30-40% year to date. So there are other names. And if you are a stock picker and not trying to call the markets like all these yeah but bears, always trying to make all these market calls, which we talk about in the report, by the way.
You just made a big market call yourself.
I know that's part of my job to make a market call because I've published my year ahead piece. But if you're focusing only on the indices and only on the market in general, you have to look at the stocks from a bottoms-up basis, and that's what we do.
Steph, let's debate this. 5,100 base case, earnings 250, or 5,500 bull case.
I just want to say higher. I don't know what the number is going to be, but I do think if the economy hangs in there, it is all about earnings, and earnings probably get revised higher. I think they already have actually been going higher, and that's been the big surprise. And stocks follow earnings. And so that's the real story in my mind. And I think a lot of the economy is growing because we have a lot of stimulus still put in place. We just put $2 trillion. We haven't even put $2 trillion. We passed $2 trillion in infrastructure spend. That's not even going to get into the economy until next year, Scott. So that's a nice tailwind. And then I say, then I look at inflation coming down. Absolutely, that's positive for profits. And inflation in general is just a good, when it comes down, obviously that's very powerful.
Oh, so you're in Camp Belsky, where Lori Calvasina is 5,000, Savita at B of A is 5,000 for next year. Costin's a little bit below that, not looking for a tremendous amount of upside for 2024. But the way that Brian lays out his scenario makes good amount of sense.
To me, it does, because that if earnings are going higher, your PE is coming down. So the market's actually more attractive. So to me, yeah, I mean, I don't know the number, Scott. I really don't. But I do think that there's so much in terms of tailwind in the economy that we're able to handle these higher rates, and now they're coming down. So I think that's very powerful.
So something that Brian suggested, I think, is very interesting, and I think for the viewers, it's something that you have to think about within your portfolios, and even from a trading perspective. And that's the fact that equal weight can finally have mean reversion, can finally have a degree of outperformance over more than just a weekly period, over a multi-month period. And let's include small caps in that conversation. I think the real test comes in the month of January. You'll know quickly. In the month of January, if you see the same type of pattern that we had last year, in which at the end of the year, you knew where you could identify where the tax loss harvesting was, right? All the tax loss harvesting was actually in the Magnificent Seven, was actually in technology. What happened in January? It caught everyone by surprise. And in January, that's where the leadership is. You should see the same pattern in the month of January if your belief that you're going to see dispersion, if you're going to see equal weighted strategy, if you're going to see all the equity size classes participate, you will see in the month of January that that's where the significant outperformance will be. It will reverse what has gone on here in Q4, which is tax loss harvesting in the Russell, tax loss harvesting in EVs, tax loss harvesting in clean energy, tax loss harvesting in biotech.
Does that make sense?
Yeah, but you know what I was thinking about when he's saying this? Financials, right? I mean,
again?
Come on, Scotty, get on board the train.
Well, I'm glad I didn't get on the train last time.
Exactly,
you said the train was going.
So here's
what do you mean?
Here's what I would say.
People should be happy they didn't get on that train.
Well, here's what I would say. Number one, you might see some tax loss harvesting in financials. Number two, I believe that most of these companies have been massively overregulated, very, very, very conservatively managed, over-reserved, and when they come out with their earnings, they're actually going to come out and say, we're going to increase the dividend and buy back more stock. And what I really believe, too, is that next year you're going to start to see more M&A activity, especially within some of the regional banks, Scott. And so I think in your portfolios, if you're making sector calls, it's technology for growth and financials for value. Lastly, I would say the other area to look at that I haven't really talked a lot about on the show is private equity, because if interest rates are starting to go down, private equity firms do a lot better. And so I think that's another flair that you can add to your financials and not just the banks.
What about financials, Jason Snipe, here? Remember, Belsky famously, like a year ago, we said, what sector do you like? And he said, financials, financials, financials. Right. Three times better than one.
I remember.
He remembers too.
Yeah, absolutely. So as it relates to financials, I think for me, I still like the brokerage firms. I still like, the IB part of the business. I don't really love the money center banks. I'm not super bullish there. But to Belsie's point, I think a couple things. If yields do pull back, we talk about these trillions of dollars that are in money markets, and breadth, which I think breadth is going to be very important going into next year. And we're talking about, again, tech has been the lead. Obviously, Joe, you pointed that out. It's done very well this year. We're going to need to see breadth coming into next year. So I think financials, again, has had a great month. It's up 9% this month. I think we could have some capital go that way. But again, I think it's going to really depend on interest rates and where flows go.
I'm surprised, Brian, that you're underweight, or you're advising people to be underweight energy and materials if you're as bullish on the economic picture as you obviously sound as though you are. Why would I want to be underweight those areas, especially after what's been a really, down year for energy specifically?
Well, first off, if you look at CPI and PPI trends in the underlying commodity, if you correlate that to the performance of the sector, it's pretty correlated. And if we have a really cool chart in the report that shows it's about halfway down in terms of where we could see a bottom in energy. That's number one.
And you mean in like oil prices?
Oil prices in the energy sector. We still think that many of our institutional clients are actually overexposed to energy, and there's going to be some more selling coming in there. I think that's a big part of it. Number two, on the materials side, I think global growth is going to be still squishy the first half of the year. And remember too, if I look at the market sectors like a portfolio, and if I'm running money, which I do, I look at what stocks can I own in those sectors. And if we run money like we do, 40 to 50 stocks in a portfolio, we're concentrated. And if you're talking about a 2.5% market weight position in a particular sector like materials, or 3% in energy, you're probably going to own one name. That's it. And so we want to be very, 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 very confined in what we buy and very, very structured.
You're like better than 6% in energy, and you have like a dozen names.
Well, and I've stated that I'm very concerned about where energy is, and the reason I'm concerned is positioning, and that's what you're speaking towards. And that's where I agree with you. I think with energy, positioning is most critical in terms of where the direction ultimately is going to be. Where I disagree with you is what you said on financials, because I don't think the positioning is there where you're going to see the tax loss harvesting effect. The reason I say that is because the regional banking crisis pushed so many people so quickly away from financials. And I really think when you look at ownership of financials, it's really in a neutral positioning. Can I tactically identify Morgan Stanley or Goldman Sachs as two companies that I would want to own? Absolutely, I can. But I don't see that you're going to have that type of effect in financials that you could have overall for small caps itself. And just back to energy, look, we have an OPEC meeting at the end of the week. And as I said before, to me, it's similar to Alabama being 4th and goal on the 31 and throwing, a touchdown pass to Isaiah Bond in the corner. That's exactly what we need from OPEC this weekend.
So, Steph, on that note, you sold Chevron, which you kind of were fed up with it, right, after earnings were bad. I think you had sold some, and now you sold the rest. Yeah. Is that right?
Yeah. I mean, it really wasn't a good quarter. I think they're distracted from all the M&A that they're doing. They're not returning cash to shareholders like we expected. That was disappointing, too, in terms of the buyback. So I just think it's going to sit here for a while, and there's other places that I think have more upside.
Like what?
Well, I used the money to buy Freeport, a small position in Freeport. It's down 18% from its highs. It trades at 8 times EBITDA. I think the destocking is coming to an end. Inventories are historically low. China has remained strong, running up about 10% in the face of a weaker economy. So if they do get better, obviously demand will go up and higher. And I just think the valuation, the risk reward is just so much better for this one. And they're executing, Scott. And Chevron right now, they're not.
Jason, you own Chevron. Are you as fed up as Steph?
Oh, man, Chevron, it's been tough. It's been a tough year. It's down 20% year to date, down almost 10% over the last 3 months. To Steph's point on the acquisitions, the M&A activity, I do like the acquisition of Hess. I do think that's going to be accretive to the stock. I like the assets in Guyana. I like the assets in the Gulf of Mexico. But the stock has been walloping and hasn't done well. I mean, the revenue was down 50% year over year this past quarter. So, but if I'm going to be in energy, I want to be in the fully integrated names, and Chevron is that for us.
Belsky, you own Chevron too.
I do, and dividend growth. And I buy it. There's three parts of dividend growth. So there's a core name that's never cut a dividend. There's dividend growers, and then there's yield. Chevron's part of our yield component of it. That's the only reason why I own it. I think structurally it's in trouble, and I do agree.
But isn't there another large oil company you could own instead if you're going for a yield play?
There's one called Exxon.
All right. But it's not like you're the only ones who fit the bill for your yield call.
It isn't. We chose that one because at the point when we bought it 5 years ago, it had a much higher yield.
And right now you're staying with it.
We're staying with it.
Joe, you own it too?
I do. You want a trade alert, though? I want to give you a trade alert. Market on close today, I'm a buyer of GLD. I like the Freeport-McMoRan. The Chinese are beginning to increase their exposure, utilization of Freeport-McMoRan. Hopefully that takes it off the lows, but gold is breaking out.
All right, hold on. So you're going to buy the GLD on the close?
I already have it in.
It's like 2,000 now, right?
Gold is breaking out. Gold is breaking out. There's also a correlation between the direction of where inflation is. It's interesting. People always say gold, inflation. No, it's gold and a disinflation trend where you begin to see gold appreciate. I like what I'm witnessing in gold. The way I'm going to play it is GLD. Market on close, I'm a buyer.
But you still want to be underweight materials, though, Belsky.
In the U.S., but we're overweight gold in Canada. Because
that's a home team call. I almost put an asterisk by that.
No, because listen, I think we do think that global growth is going to be squishy. The only name that we're owning in the material sector is Stephanie. We're owning Freeport-McMoRan because I think it's a great contrarian name. It has not done very well. There's been a lot of forced selling in that name, and I think that there's some upside there.
Okay. You own Freeport too in the Joe T?
We own
still.
We own Freeport. Freeport has been in a little bit of a struggling position, as we've said, but I like what we're seeing fundamentally from the Chinese, and that could be a positive catalyst over the coming quarters.
See, I like people are trying to pick these, make these contrarian calls on areas of the market that didn't do great this year that they think are going to have all of a sudden a good 2024, such as Wells Fargo, for example, utilities, healthcare. Do we have any reason to believe that, if rates are going to continue, Steph, to come down, maybe utilities catch a bid on that? But what about healthcare? Another big disappointment.
Very disappointing across the board, and not even just biotech. Pharma, those stocks are trading at single-digit multiples, and the yields are really pretty interesting. I think, maybe there's a catch-up trade there, but I don't know if there's something out there in the elections that's kind of putting a little bit of a kibosh on the group as a whole, but it just doesn't act very well. I'm very stock-specific. I only own two names, and you know what they are. We're going to talk about one in the next block.
Brian, what about utilities? What about healthcare?
We upgraded utilities to neutral.
Wow.
That's exciting, isn't it? I actually telegraphed that a little bit when I was on last time because we wrote this report about the highest yielding stocks in the market being massively oversold. And so there are some names in utilities that you can own. On healthcare, it's meh, because I still think that there's this overhang from COVID. If you want to be contrarian in healthcare, actually do look at these heavy cash balances and great cash flow names in the biotech area like Gilead or Amgen. But I think healthcare is a classic neutral heading into next year.
All right, let's take a quick break. When we come back, we'll do our calls of the day. We've got a big sell call on one of Steph's top holdings, so we get her reaction to that. We'll do that in 2 minutes.
Is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
I think I'm ready for this.
Heck yeah. With E-Trade, you're ready for anything. Marriage, kids, college.
Kids moving back in after college. Here's to getting financially ready for anything.
And here's to being single and ready to mingle. Who's ready to cha-cha?
At PGIM, finding opportunity in fixed income today helps secure tomorrow. Our time-tested fixed income suite, backed by over 145 years of risk experience, helps investors meet their goals. PGIM Investments, shaping tomorrow today.
Invest with an advantage with CNBC Pro. Exclusive access to investing experts and analysts. Customized tools, wealth management, and investment strategy. Plus actionable analysis of global market coverage and the biggest names in business and investing. Become a smarter investor Become a CNBC Pro with an exclusive Cyber Monday offer for a limited time. Go to cnbc.com/pro Cyber Monday now.
We're excited to do business with you, but before we sign, I gotta ask.
Sure, anything.
We searched you online, and maybe you can explain this?
Can't believe that garbage is still coming in. That is so false.
Frustrated with your online search results? Call Reputation Defender today to join tens of thousands who've improved their online reputation. Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
The all-day, everyday pant by Public Rec. More comfortable than jeans, more stylish than sweats. With the all-day, everyday pant, you can choose your waist and length sizes to guarantee a perfect fit. Now comfort looks good.
Introducing Mando, the whole body deodorant that I created with all body odor in mind. I'm Dr. Shannon Klingman, and I'm the inventor of whole body deodorant. It's like body odor never even happens, and you're going to be exceptionally stink-free and smell as good as humanly possible.
All right, we'll do our calls of the day now. We'll start with GE Healthcare. Steph, it was downgraded to sell. This is from UBS. They say margin disappointments are coming. Target cuts to 66 from 86. They call the risk reward unappealing in the near term. They say guidance is going to be tough to deliver. Orders, comps, and pricing are 2024 headwinds. Margin delays ahead. It's one of your biggest positions.
Yeah, it's done well year to date. It's up 26%. This analyst had a neutral on it all the way up. That being said, it is down 16% from its high, so it has sold off, I think, on these concerns. I think on the margin concerns for sure, but I think they're taking market share. I think the medium to long term, I think you're going to see mid-single-digit total revenue growth, EBIT margin expansion in the upper teens. So does this analyst, by the way. When I was reading the note, it didn't really read that negative. It reads more negative in the immediate term, near term.
Yeah, what they say in the midterm.
Yeah, well, they're listening to Siemens, and Siemens is talking about a slowing in China. It's entirely possible. I think GE Healthcare has taken share from Siemens in China. So I think the evaluation is attractive. I like spins. This is a spinoff from GE. Spins work because all the management, they really are dedicated to investing in the company, R&D, and providing growth, which is underappreciated when you're part of a conglomerate like it was. So I like this very much long term. If it sells off more, I'll buy more.
Oh, okay. Back to healthcare real quick with you, Joe. The ones you own, Merck, Bristol, and Pfizer?
Well, no, Merck, Bristol, and Pfizer are three names where I think investors need to be focused on in 2024. If you think you're going to get that rotation into healthcare itself. The name that we own is Eli Lilly. And Eli Lilly is capturing all of the healthcare flows right now. Bristol, Pfizer, Merck, they are trading at the lower end of their 52-week range. Merck is actually a name that I own for quite some time that I sold out of.
The thing is, like the weight loss drug phenomenon is why.
But here is why I think this is so critical to isolate on those three names in Lilly itself. Because if, in fact, the fever breaks surrounding the weight loss, surrounding Ozempic, what you will see is capital flows very quickly go into those three names.
Why is it going to break?
Pfizer,
I think J&J too, to be honest with you.
as well.
That stock has been a dud.
J&J, you can include J&J in that conversation, but understand you're getting rewarded in a large cap healthcare name, Eli Lilly, to the degree of which you haven't been able to get rewarded this year in its entirety from the overall sector. You're getting rewarded almost with biotech type returns. So that's where all the capital is right now resting. Once that capital, the fever breaks, that capital is going directly into those other big cap pharma names, and I would include J&J in that.
Assuming that the fever, in your words, breaks. If you only have a certain percentage of your portfolio to allocate towards healthcare, you're going to go where the hot money is.
You're going to go where the momentum is. And I'm a classic example of that. I am right now specifically in Eli Lilly, but I am sure fevers tend to generally break at some point. I'm sure 2024 we'll be sitting here on the desk and we'll be talking about the fever breaking surrounding the weight loss drugs. And at that point, you'll see these other names will benefit from it.
All right, Steph, McDonald's reiterated buy BTIG. That's ahead of the investor day next Wednesday. $300 is the target. You bought it recently, right? You bought it back recently. recently.
Yeah.
They say, quote, we believe McDonald's is ready to accelerate unit development across the globe with increased openings in the U.S., focused on the South and Southeast regions, given population trends.
I mean, I like the stock. I'm not crazy about the call because the stock is up 10% from its lows just a month and a half ago. So it's had a nice rally, and I think it's in anticipation of it having a positive analyst day. But this is a company of a massive scale and size, taking market share everywhere, and they just grew global comps at 8.8%. I mean, their strategy is digital, drive-through, and delivery, and those 3 Ds are working for the company. It's not cheap at 24 times forward, but the long-term average is 26 times, so it's a little bit cheaper, but it's not super cheap. It acts like a defensive, and that's kind of why I own it.
You own it too, right?
Yeah, we like it. Comfort food. If we think the consumer thinks they're going into recession, they're going to go have an Egg McMuffin and a Diet Coke all day long. Versus, we really like some other names in
That's
restaurants.
how deep the analysis goes. I mean,
You know how deep that
that's
goes?
the fundamental
Did you
analysis.
like that? No, we own it in our value portfolio. We've owned it for a year. We were wrong for a while, and the stock has been underperforming. But this is just one of these names in the restaurant industry I think you want to own.
Okay, what about Old Dominion, Joe? That downgraded today to hold from buy at Deutsche. Target to 386 from 475.
You left out why they downgraded it. They downgraded it based on valuation, and I really dislike this call. You're downgrading it based on valuation. Well, guess what? At times, it is traded at an actual cheaper valuation and gone lower. So valuation is not the indicator for this stock.
It's not the only thing that they talk about. They talk about how, from a competitive standpoint, they are, quote, leaps and bounds ahead of their competition.
Positive.
Quote, but the gap is narrowing, which may have negative implications for market share.
The gap is narrowing?
That's what they say.
Okay, well, I don't see that. I see a company that's raising general rates 4.9% in the month of November. I see a company that has pricing power. I see a company that's benefited from Yellow Corp's bankruptcy. I see a company that has endured itself through the freight cycle, actually declining. And now on the other side of that, if you see good spending return once again, this company is going to benefit more than most. Why? Because they have competitive market share advantage over the rest. I still go back to the valuation argument. I think the valuation argument on this stock is completely wrong. There's a premium that you should pay for this stock because it's got the balance sheet and because competitively they are at advantage to others.
Okay.
That's a 36 times forward estimates. That's a pretty rich valuation.
Okay.
Pretty rich.
Okay.
That's it? Just okay? 36 times.
Okay. It could go to 46 times.
It's
not going to force me out of the stock.
What do other names in the space trade at from a valuation standpoint? Do you have any idea?
Cheaper than?
I mean, I don't.
XPO.
Cheaper
and
than that.
It's up there too. It's up there too. They're the leaders. They are, and they're benefiting from yellow freight. Clearly, I don't know how sustainable the growth is though as a result of that.
Right.
Okay. As Joe said, okay.
Okay.
Twice. Let's get the headlines now with Silvana Henao. Hey, Silvana.
Hey, Scott, good afternoon. Qatar officials announced an agreement to extend the Israel-Hamas truce for 2 more days. The deal could include additional aid delivered to the Strip and the release of more hostages and prisoners. The original 4-day ceasefire deal was set to expire today. Elon Musk visited Israel today, where he toured a kibbutz with Prime Minister Benjamin Netanyahu, the village that was attacked by Hamas on October 7th. The visit comes as Israeli officials announced that the country reached a deal with Musk's Starlink satellite internet company to make communications available in the Gaza Strip. And a new island is forming near Japan after a volcanic eruption. The island is about 750 miles south of Tokyo and has grown more than 160 feet in 2 weeks. Officials are warning ships to be careful navigating the area due to continued volcanic activity, Scott. Pretty cool.
Indeed. Silvana, thank you. That's Silvana Henao. Up next, ETF Edge. How you can invest around the rapid changes happening in tech right now. Halftime's back right after this.
Cyber Monday.
We're back now to Bob Pisani with today's ETF Edge. Hey, Bob.
Good to see you, Scotty. I'm joined now by a very special guest. Morgan Housel is a partner at the Collaborative Fund and the author of the best-selling book, The Psychology of Money, which has sold over 4 million copies worldwide. This is one of the best-selling financial books of all time. He's out with a new book right now, same as ever, Guide to What Never Changes, noting that while technology and change seem to be accelerating, human behavior is not accelerating. He joins us now. Thank you, Morgan, for being with us. Your key theme is that investing styles and technology are ever changing, but human behavior doesn't change at all. Now, why is this such a key concept to grasp as an investor?
Well, thanks so much for having me, Bob. I think it's really important because all of our attention in the industry, the vast majority of it, goes to what's going to change. What's the next big technology? When's the next recession? When's the next bear market? The collective track record of accurately predicting those kind of things is not great. But for me, as a financial journalist, I was always just interested in looking back at financial history and realizing what does not change. The behaviors that were the same thing 100 years ago as they will be 100 years from now. So if we put all of our emphasis into those behaviors that never change, I think it pushes us much closer to a clear view of what's actually going to happen in the future.
Yeah, you know, a good part of this book is dedicated to evaluating risk, and you do so well explaining this. You've got a great chapter explaining why so many events that are supposed to happen once in 100 years seem to happen all the time. A 100-year flood, it happens. A 100-year hurricane happens. A 100-year pandemic happens. A 100-year stock market crash happens. They seem to happen all the time. Explain that seeming anomaly to us. Why do these 100-year events happen all the time?
Well, look, if in any given year there is a 1% chance of a catastrophic hurricane, 1% chance of a terrorist attack, 1% chance of a pandemic, on and on and on, in any given year, one of them is going to happen. So in almost any given year, and certainly every decade, we have these events that seem like they were completely out of the blue, black swan, nobody saw this coming, once in a lifetime kind of thing. But since there are so many of them, it happens every single year. I've been an investor for 20 years, not even that long. But in every period during that time as an investor, there have been a million things to look at in terms of reasons not to buy, reasons not to be an investor. Markets overvalued, the economy is weak, politics is a mess, go on down the list. And during that period, the market's up almost fourfold during that period. And I think that is kind of the common path of history. At any given period, there is something going on that seems like it's catastrophic and seems like we should not be able, we should not deal with this as an investor. And that's the normal path. Yeah. And then you look back over a long period and realize like that's where the rewards are.
Yeah. There's also a great chapter on the right way to view inspired but crazy geniuses, as you call them, like Elon Musk and Steve Jobs. You even bring in Walt Disney, the man, and talk about him as a bit of an eccentric. So what's the right way to look at these people, at the Elon Musks and the Steve Jobs of the world? You have some comments on that.
Well, it's always the case. It always has been the case and will be that people who have unbalanced success, they have extraordinary success, are by definition not well-balanced people. And because of that, there are going to be parts of the world, the thoughts that they have, the beliefs that they have, actions that they take that we disagree with. Of course, if they are thinking about the world in good ways that are out of the box and kind of crazy, of course, there are other ways that they think about the world that we might disagree with or find repulsive. That's always been the case for all of these people. Yeah. Steve Jobs was like that. Isaac Newton was like that. Walt Disney was like that. One other way to think about this is that people who tend to be very good at one thing tend to also be very bad at another thing. It's like your mind only has so much bandwidth for so much attention. And if you are a kind of person who is devoting your entire life to your business, your investing strategy, whatever it might be, the huge majority of those people are going to have major deficiencies in other areas of their life. So be careful when you're trying to emulate their behavior or look up to their life without getting a full sense of the cost of what they're doing.
Yeah, now I'm going to have a lot more. We have a lot to talk about with Morgan. We're going to have a lot more on timeless investing wisdom, including his thoughts on ETF investing, index investing. Coming up, Morgan Housel is going to be with us for 20 minutes on ETF Edge at 1:10 p.m. Eastern Time. He'll be joined by Dave Naudick, the financial futurist at VettaFi. We'll also be discussing the explosive growth of zero-data expiration options. That's etfedge.cnbc.com. Scott, back to you.
All right, appreciate that. Bob, thank you. Bob Pisani up next. Mike Santoli joins us with his midday word. We're back after this. Dow's down just about 100 points.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
We're back. Senior markets commentator Mike Santoli. There he is, joining us now. I've got a VIX under 13 still, and nothing really doing much other than mega caps today.
Yeah, and really mostly just kind of a hold as opposed to, kind of more progress on the upside. I think that's probably okay. To me, the big debate is, yeah, sure, we're sort of short term, just a little bit stretched technically, but there's been a lot of repair to the overall trend. I mean, the equal-weighted S&P is up 6% total return this year. It's not a disaster that it was looking like a little while ago. So overall, I think it's okay. NVIDIA's 5% off its high with the S&P, less than 1% off the July high. So I think everything's working together. It's a matter of whether we have to be bracing for another growth scare or another yield scare, if any. But those two things, I think, are in a nice, delicate balance for now. See if that changes. VIX under 13, to me, not that big a concern. It's been very quiet trading. The market's been closed the majority of the last 9 days. We'll see if it rebuilds from here.
Yeah, sure. Volume feels really light. What do you make? Most targets coming out around 5,000 here, 5,000 there. Belsky's got 51 base case, 55 in a perfect scenario.
Yeah, I think it's coming off of a year when the street was a little bit too negative for what the S&P did. So I don't see sentiment as getting overexcited at all. 5,100 to 12% gain from here. That's pretty much in the ballpark of what you'd start to see on the bullish end. So I don't think everyone is hating the rally. I don't think you have a great consensus that we have economic doom ahead of us as we did a year ago. But to me, it's not yet to that point where people are getting a little frothy and just extrapolating good times. 5,100, as I said before, is a whopping, 6% above where we peaked in early 2022. So that would be a 3-year return of 6%, not necessarily running away to the upside.
Not as great as it would seem. Mike, thanks. I'll see you in closing bell, a couple hours. Coming up, mega cap tech. Well, we got stocks hitting new highs today. We'll talk about that and much more coming up.
Call us today.
We're back. Microsoft hitting another all-time high. There's the chart, 380. Brian Belsky, I'll go to you. I mean, is there any reason whatsoever to think that these stocks are just not going to continue to work in the new year, even if there's some sort of pickup in these other areas? I just don't buy the argument that money's going to come out of mega cap and just go into all these other places.
Yeah, I think the issue with the mega cap is it's probably not going to be all 7. Maybe it's 4 or 5. You're already starting to see some different performance trends from not only price performance but fundamental performance of the Magnificent 7. I think Microsoft can do very well under being kind of that core holding in tech, and then other names around that.
When you say, you can already see others not performing, what are you talking about? Like who?
Well, look at Google. Google's been underperforming, not in the month of November because everything went up, right? But you look at year to date.
A couple of days?
Well, look at how Google has been underperforming relative to, let's say, Microsoft, relative to Netflix. Look at NVIDIA coming back as strong as it has been. But look at also the way that Apple has been not as strong as before. And Amazon earlier in the year was not leading, but it started to catch up. So we're starting to see some different trends in that.
Apple's up 13% in a month. Steph, Amazon, your biggest position, right?
Yeah.
So, obviously, you could get another nice game today based on the fact that Black Friday sales,
they're
and now we have
winners.
Cyber Monday and all that expected to be good too.
They're winners, right? And their free cash flow is ridiculous. $36 billion this year is expected. I mean, they had just a flawless quarter. They really did in terms of revenues, earnings, operating income. Operating income was double what they guided at the low end of the range. AWS, they signed 4 new clients in the month of September, so you're going to see an acceleration from 12% to 15, 16% for next quarter. And margins on the retail side are much better than expected. So I still like that one, but I will say, kind of under the radar, and we talk about it a bit. I know. Lam Research. Goldman put a note out today that was really sort of interesting. They're raising their wafer fab equipment numbers, and it kind of didn't get a lot of attention. Why that's important is because obviously that's what these guys do, and we have been waiting for a trough. And so I think that there are some definitely pockets within tech to own that are not the Magnificent 7, and that one would be right up on. It's like my second largest position.
You think NVIDIA got a little ahead of itself or no? Right, it went from 400 on Halloween to 500 as it was reporting earnings. Now it's come down, $20. Right. It still had an incredible move. It's up near 20% in 1 month's time. Right. But what about that name here? I thought maybe Belsky was referring to that over the last few sessions. As maybe it's due for a little bit of a pause.
Right. So, clearly the revenue growth year over year up over 200%. Data center was amazing. Gaming was really strong. But yes, the stock is up 240+% year to date. With that type of move, there is some retracement possibly that's coming ahead. But I don't think, contrary to what Belsky might have been talking about, I don't think there's a pause into next year. I do think data center strength will be strong, and I do think gaming will also come back.
Got to pause maybe for a couple of days, and it looks like today might be the day where it begins to reverse and move higher. But for there to be a significant sell-off in NVIDIA, you have to have justification that there's something wrong with AI and the thesis of AI. And clearly Microsoft is telling you that it's the complete opposite of that. In fact, you could call this an AI breakout, and just look at Broadcom. Look at the performance of Broadcom as it approaches 1,000, and that's confirming that AI is still in a great place.
Yeah, the moves in these stocks are mid double-digit percentage points. It's been an incredible run over 1 month's time. So we'll take a quick break. We'll come back and give you the setup for a number of software names that are reporting earnings this week as well. We'll do that next.